What do you need to know about charitable giving? On this episode of Through the Pines, we'll discuss charitable giving topics like: do you come out ahead financially? What are the tax consequences? Itemized deductions versus standard deductions. What are CRUTS, and CLT? Family foundations, donating appreciated stock, and qualified charitable distributions. Welcome to a financial planning podcast with a down to earth vibe. Sasquatch listens while fundraising for his nonprofit, Saving the Forests. This is Through the Pines. Our advisors for this episode, we welcome back Rex, Baxter, and Brandyn Smith from planwithbaxter.com. They are the 2023 and 2024 Forbes Best in-state wealth management teams for Utah, along with the Advisor Hub's fastest growing advisors to watch under $1 billion and the receivers of the Ameriprise Client Experience Award, which means they know what they are talking about. Again, you can reach them at planwithbaxter.com. Rex, welcome to the podcast. Thanks for coming back. We tried to ditch you last time, I think.
No, I appreciate that. Thanks for inviting me back. It's always a pleasure.
Yep. So we this week, and by try to ditch you, I mean we just we cut the conversation maybe a little short. We could have gone on for hours, and so every now and then we have to save it and stop it around 40 minutes. This week we are chatting charitable giving. Is this a hot topic? How often is it seasonal actually, because we're coming up on Thanksgiving and Christmas time of year, or is it, no, we just talk about this whenever we put together a financial plan?
So we talk about it pretty regularly. I would
Okay.
say I do think that even though we bring it up regularly, I do think a lot of our clients bring it up with us towards that fourth quarter of the year as they're starting to look at their tax situation for the year, where they're at, and they're trying to maybe make some money moves.
So has nothing to do with the holidays, folks. It has everything to do with saving money with your taxes. So totally makes sense. All right. So in the end, if you participate in charitable giving, do you come out ahead financially? Who wants to take this, Brandyn or Rex?
I need to take this one. So,
Okay.
because it's perfect with what you just said. I can't tell you how often, like, people be like, but they're getting a charitable, they're just doing it for the tax write-off. Or I've even had clients come and be like, I've been paying way too much. I'm getting killed with taxes. I need to donate to charity. And they're not wrong, right? Donating to charity, if done right, can absolutely help with taxes. But I think what a lot of people don't understand is that when you're giving to charity, you're still net losing money, right? And so for example, right, if you're, let's just say for easy numbers, you're in a 25%, bracket, which isn't even a bracket right now, but let's just easy numbers, 25% bracket. If you give $1, then you get to deduct that $1 and you save 25 cents. I still had to give $1 to save 25 cents, right? So I'm still net down 75 cents on the dollar. Now, someone might say, well, why would anyone give charitably? Well, there's plenty of people who want to give to charities, or they want to give to churches, or they're planning on gifting to various charitable organizations already. And so if we do this correctly, we can still give to those charitable organizations while also maximizing their tax benefits from that. And so that's really what this podcast is about, is not, hey, we're going to save you a bunch of money on your taxes by donating charitably. It's, if we're already planning to do some charitable distributions and donations, let's make sure we do that in the right way so that we can make some good money while we do it, or save some tax money while we do it.
That makes sense. Rex, do you, when you correct people, do they change their mind and now they don't want to give money to charity anymore because it didn't save them as much as they thought it would save them?
No, typically people are giving because they're passionate about a cause, right? And so normally it's something that they feel very, very strongly about. They're going to give anyway. It may influence how much they give, whether they increase more to try and get themselves into a slightly lower tax bracket, or if they end up giving slightly less because they understand the impact of that. But I don't feel like that necessarily changes. I think even though at a surface level some people don't fully understand that, I think that they're still going to give. If they're going to give, they're going to give.
Okay, but the number that a mathematician would tell you would be no, you do not come out ahead financially. Is that correct?
Correct. You might come out morally, but you don't come out financially. Yeah.
Your life
So
might be dramatically more enriched, and I mean, there's a whole lot of things we can go into here, but financially, maybe not so much.
Not so much. Okay. Well, no, that's good to know. It's good to know. Okay. So let's dive into tax consequences, Brandyn. How does it help you? So then at the end of the year, because that's, they're like, hey, I got to save on my taxes. Well, by giving, does that help you?
Yeah, it can if you are going to give already, but there's a few different things that we can. There's different ways, right? Because I've also come across quite a few people who will donate to a charity and think, oh, perfect, I'll get my tax deduction. They'll get the slip from the charity. They'll turn it into their accountant. Their accountant will crunch the numbers and be like, yeah, we're doing the standard deduction. And a lot of times people don't put that together, right? If you're taking the standard deduction, which a lot of people are now, the standard deduction in 2024 is $29,200 if you're married filing jointly. It's $14,600 if you're filing single. What that means is that if you're, let's just say, married filing jointly, you need to have more than $29,200 worth of charitable distributions, interest on your home, like property, right? There's a few different things that can add to that number. Not a lot though, right? Most of it comes down to charitable contributions and interest on home. You need to exceed that 29,200 before it starts to make sense for just a regular charitable contribution. If done just kind of like the regular way people have done it, and are probably most familiar.
So you would need to have a high income in order to make that make sense, I guess.
Not necessarily high income, but you would need to have high charitable distributions. You'd need to have high, interest, mortgage interest would help you get there, right? Things like that, and then you can do that. Now there are ways around that, and we'll kind of get into that. Before we do that, though, I think this is a perfect time to talk about gift taxes, right? If we're gifting to kids or to family, or to friends. And I think this is really appropriate for this time of year going into Christmas, right? We can make some shorts of this and let people share it with their favorite rich friends, right? How much they can give them. I'm just kidding. But essentially, so for the year 2024, there's an $18,000 gift tax limit. What that means is that you as a citizen can gift up to $18,000 to any other citizen and not have to file it, not have to report it on your taxes, right? There's no additional taxes made. And so we see quite a bit where people will use that gift limit every year to try, and if they've got a large estate and they're trying to shrink that out, if they've got kids that they're trying to help out and donate money to, or people that they want to give money to, but they don't want to go through all the hassles of filing the lifetime exemption, tracking things on their taxes, you'll see people gift $18,000 per year per person. Now, one thing on that's per year per person. So if I had a bunch of money and I want to gift it to a couple, I could then do $18,000 to the husband, $18,000 to the wife, right? And now I've just doubled that and I've gifted $36,000. Let's say there's two couples. An older couple that has more money, they're gifting to a younger couple, you can then do that 4 times, right? The husband can give to a husband or wife, and then the other spouse can give to a husband and wife, right? And so you can actually, I don't want to say get creative with it, but you can actually end up gifting quite a bit per year. And that 18,000 goes up usually every year.
Okay. So you can impact your taxes in a positive way, Rex.
You can impact your taxes in a positive way by charitable giving. As long as you get over that standard deduction to the point where you're itemizing, then it's going to reduce your tax liability. And so it is a more efficient way. There's more efficient ways to do it than not if you can get into that itemized deduction status, which I'll have Brandyn talk about here in just a second. One other thing on the gifting that to family and things like that I might just tag in here, and it's not it feels like charitable gifting because you're giving it to a child. But one of the big mistakes that we see in gifting to family members is a parent putting their child's name on their house, right? And we see this all the time. They're like, well, it's a more efficient way to transfer it, things like that. And so all of a sudden, I own this $500,000 house. I'm going to put Johnny's name on it with me, and that way it's going to transfer. Well, technically, that's a gift over $18,000, and so technically, you're going to end up paying gift taxes on that, or start using that against what they call a unified credit or your lifetime gift limit, which you have to track every single year for the rest of your life on your taxes. And there's a separate form for that.
Yeah.
And so if you ever get audited, that's a major deal. And so even though that's not about charitable giving, we're going to circle back around to charitable giving now. But that is a mistake that we see a lot of people making it from a gifting standpoint.
Yeah. So then,
All-
Brandyn, you had a comment?
Yeah, I also want to point out gifting to children, right? Let's say you're like, hey, I want to gift $18,000 to my kids. That's not a charitable contribution either, right? You can't gift money to a friend. You can't gift money to kids and then deduct that on your taxes. That's you just don't. If you keep it within that 18,000, you don't pay the additional gift taxes that could be due. And so that's an important distinction, right? If you want to take a charitable deduction on your taxes, you need to be donating to a qualified, what's called a 501c3 charity, right? A charity that's established, that is a qualified charity in order to take those tax deductions.
And when you do, they give you the paperwork to prove that you have done so, which is nice.
Right.
Okay, so do you want to, we touched on itemized versus standard. Did you want to define those more?
I think we did a pretty good job, but I think the thing to keep in mind, right, is if we're wanting to make charitable contributions, and you're taking the standard deduction, meaning that your charitable deductions and interest, and there's a few other small things that can be added to that. But if those are less than 29,200 married filing jointly, or less than 14,600 filing single, then we're going to want to maybe look at some other routes, right? Because if it's less than, then you're just going to take a standard deduction, and those charitable contributions aren't doing you any good tax wise. Okay. Morally, great, but tax wise, not helping you.
Yep. And we're all about morally winning at life. So
let's get financially though. That's the catch.
And financially. Some acronyms here, and these do sound like bad words, but they're not. Or maybe they are. I don't know. We don't. So CRUTS, and CLT. These are some abbreviations. Brandyn, what are we talking about here?
Yeah. So charitable remainder annuity trusts, charitable remainder unit trusts, and charitable lead trusts. And at a high level, the reason you use these is let's say you had a huge income year. And we see that for various things, sometimes divorce and payouts, and sometimes people sell a business. Sometimes people just have a good year at work, right? And so sometimes income jumps really high one year, and then it's going to be lower in future years. And so what we can do is we can use some of these, make a charitable contribution while also retaining some income for ourselves. And there's some nuances in these, but retaining income for ourselves, or retaining a future benefit for ourselves or other people, while also still being able to take a charitable distribution in that year. Okay. And so I guess a couple kind of ratios so people get a feel for what that looks like. So the first two, charitable remainder annuity trusts and charitable remainder unit trusts, are very similar. The main difference between those two is a charitable remainder annuity trust, you're going to elect a percentage of the trust up front that you're going to receive every year. That percentage is between 5 and 50% of the trust assets you're going to receive. And then whatever's left after that designated period of time, the remainder, charitable remainder, whatever's left gets donated to a charity. Now, the catch is those payments, that stream of income that you get, is taxable, right? So you're still paying tax on the amount you're getting, but it does allow you to calculate and say, hey, I'm going to eventually give this large sum of money to charity, and you can take a distribution based on that future charitable distribution. The main difference between an annuity trust and a unit trust is the annuity trust just has a set payment that's determined once at the beginning, between 5 and 50%. The unit trust is going to be valued each year, and so you can have some variability to how much you're taking, throughout, depending on how investment accounts grow.
Okay. Rex, anything on the CRUTS, and the CLT?
Lions and bears and tigers, oh my.
Yeah. Oh my.
And so I can't underscore the complexity of these strategies. And so, sometimes people will
Good point.
try and do things on their own. They'll try and become, internet geniuses and things like that. These strategies are extremely complex, and most frequently we're working very closely with either their accountant, a tax attorney, or both, or their regular estate attorney as we're putting these strategies into place. Um, it does get a little bit complex as to, okay, how much are we going to put into a CRUT, a charitable lead trust, or one of these instruments, and how much of a write-off do we get based on how much we're putting in, and then how much are we going to pay in taxes on the income coming out, and is that offsetting? And so one of our clients here a number of years ago, we had some really appreciated stock, right? The stock was worth maybe $10 million. Originally, maybe they had bought it for about $100,000, and so it really appreciated over their lifetime. And they were going to put it into this charitable trust so that they could sell it, diversify it, avoid the capital gains on that. And then they were going to take out a certain amount of income every single year. And in a situation like that, you have to ask yourself, does it really make sense to save a 15% capital gains tax in order to start paying a 22% or a 24% income tax? And so you have to think through these things at a deeper level and run some scenarios with your accountants to see if that's really going to enhance your financial picture and still accomplish your charitable giving goals that you're trying to achieve. And so I just want to make sure and get that point across, that these are extremely complex. These are strategies that oftentimes we're using with our high net worth clients. So those clients that typically have a 5 million net worth and above are typically who we're using this with. But I think they're all fantastic tools that can be utilized to give money over time to charities at your distribution rate. And if you want to still pull income out of them, we can still structure it as such. Or if you want income to go to the beneficiaries or to your kids, or skip a generation and not get into generation skipping, tax issues, some of those other complexities, these are great instruments for us to utilize. Does that make sense?
Skipping generations, man. I feel sorry for that generation. I don't know.
It's okay. It's the millennials. I'm just kidding,
Oh,
millennials. We love you. I'm just kidding. We love you,
Hey,
millennials.
I'd be happy if someone wants to skip and pay me. Just kidding. Hey, couple other things that are worth noting, right? So we've talked about charitable remainder trust, where the charity gets the remaining amount. There's also the opposite of that, which is the charitable lead trust, where charity actually can take income for a period of time, and then the beneficiaries, non-charitable beneficiaries like kids or someone else, can actually receive the remaining amount. Again, like Rick said, super complex. When you'd want to use these is, again, a really high income year. You've got some assets that you want to donate, but that maybe you still need to take some income off of, or maybe we're not ready to donate all of it, but we can give some of it up. One of these CRUTS, CLTs, that's when we want to start looking at these and figuring out, hey, could this potentially make sense? And I know that right now, like these are kind of more high net worth. We've got a couple other high net worth donation charitable things, but then there are at the end there's another one that's actually really highly beneficial to most people. And so just don't turn us off right now.
Oh, no, not only that, but we're going to chat some more numbers. I think is a good time to like
Yeah,
break
we
it up
are.
a little bit. Let's get some numbers in here. And of course, if anyone is like, well, what did he say? S'more? Yeah, s'more. This is like Through the Pines. We're eating s'mores, s'more numbers, play on words. So,
And
because
you
I
can't
thought
get
about,
enough. You
yeah,
just keep coming back for the stats.
for s'more numbers. Okay. All
Yep.
right.
Yeah, so some more numbers. So this comes from MFS Research and the Bureau of Economic Analysis, and they looked up Americans spent $186 billion on pet products in 2023, which they point out was more than Americans spent on childcare in that same year. Now, the catch there, right? Like for example, I don't spend anything on childcare. I have 3 kids, but we don't send them, right? Like, and so we spend money on kids, but not on childcare. But still, the numbers on that $186 billion. That's quite a bit.
So many people spend so much money on childcare there to the extent that it's even becoming a common workplace benefit. And so you think about all the dollars spent on childcare, that's still an amazing statistical number.
Yeah.
That's amazing to me.
$186 billion. Rex, how many clients do you have that have that much money in their bank account?
I wish that there were more. Let me put it that way.
Yeah, 186 billion. Yeah,
Speaking about billions, I think
yeah,
about Warren Buffett when I think about billions of
yeah.
dollars. This summer he announced that he's giving, over $5 billion to five, getting that spread around to 5 different charities this year. And they happen to be primarily family foundations. And then there happens to be a trust in there as well that $5 billion is being given to for a
Yeah.
charitable purpose, with the intent that he's planning on giving over 99% of his $128 billion estate to charity. Now, we're going to get into this in just a minute, but most of that is going to his own family charitable trust that will be run by his 3 kids, Susan, Howard, and Peter. And so we're about to talk about family
Family foundation.
foundations.
Yeah. So how does that work? What are family foundations, Rex?
So family foundations are essentially another nonprofit or charitable entity that essentially you're putting money into with the intent that you need to distribute roughly at least 5% of it per year to nonprofit organizations in order to do that. And so it just like with the CRUTS,
5% of the 5% of the total balance, I guess.
yeah, yep. And so just like the CRUTS, CLTs, and Lions and Bears and Tigers, oh my. But I'm going to keep referring to that because it's just kind of fun and it rolls off my tongue. And so, they get the donation up front side of the family foundation, and then his 3 kids run the family foundation. Since they are running the family foundation as trustees or managers, then they can take a reasonable income for running that foundation. Now, typically a reasonable income for smaller foundations typically run 1 to 2% of that foundation amount. Now, on that large of a foundation, it's probably less than 1%, but it's a significant sum of money that those 3 kids will probably be pulling as an income stream for the rest of their lives to run that foundation and essentially give money away.
Okay. Brandon, anything that you would like to add on family foundations?
No, just that we can help people with those, and we have clients that have family foundations that we help them, get those up and going, and they're really cool because as a family or as a group, right? It doesn't have to necessarily be just one family.
And you
But
don't have to be Warren Buffett. So
right. You can set it up, and people like to teach their kids how to think charitably, how to gift, how and say here's a sum of money, and each year we have to give this much, And so let's do our due diligence and find different charities and different things we can gift to in order to help, the charitable world continue to function. And so they're kind of a fun thing, right? Like you said, you don't need to be Warren Buffett to do it. There is some extra administrative costs to that. And so it probably needs to be a fairly good sum, but if not, right, then we start looking at some of these other options like a donor advised fund or something like that. But they are kind of really a good thing to consider.
Okay, I like it. Let's move on to donating appreciated stock. You just hand your stock over to some friends or some nonprofits. How does this work?
Yeah. So a lot of people, let's say you bought a stock when it was $5 a share, you made the right decision. Now it's appreciated to $100 a share.
Mm-hmm.
If you sell that stock, you're going to pay capital gains tax, 15 to 20% usually, on that appreciation amount, right? On that 95% of the stock. Again, if we're talking financially, you'd be way better off to sell the stock and pay 15%, right? Like it's not going to be that you still walk away with 85%, maybe a hair more. But if we're going to be gifting to a charity anyway, it maybe someone's paying money to a church, or maybe someone's really involved in a hospital, and they every year they want to gift money anyway. Might as well take that highly appreciated stock that has that capital gain built up in it. We donate it in kind, so we don't sell it in the account. We just give the shares directly over to that charity, and then the charity sells it and uses it. But the charity doesn't have to pay taxes. And so it's kind of a win-win, right? We make the donation, we don't pay taxes. The charity takes the money, they don't care. They get to use the money tax-free.
So all that capital gains, no, the government never sees it, I guess.
Correct.
If you go that route, okay.
Yep.
So, I mean, if that's your goal, to avoid giving money to the IRS or whatever, you could, donate your appreciated stock and to your favorite charity. They get to accept it, and then when they sell it, and it doesn't matter if they sell it right away or if they keep it and it gets more. There's more capital gains, or how does it work?
Most charities will end up selling it immediately and diversifying it into their portfolio.
Okay.
Is how most charities will work. However, you can, sometimes I've worked with different charities and organizations, and as people have gifted large amounts of stock, it may be a founder of a major corporation, and they have significant amounts of appreciated stock, and they don't want that stock sold immediately for different reasons. Then they may put some restrictions on that organization. Say, hey, I'm going to gift you, $5 million of this appreciated stock, but you can't sell it for 5 years. However, sometimes they'll also do 10% per year or some different percentage of the stock that can be sold. Now, normally it has to be a significant gift for an organization to allow you or to accept the gift with restrictions, because it does require a fair amount of additional reporting on their end to make sure that they can accommodate that endowed gift.
Okay.
And so it's something that we work closely with different charities.
Okay. And then finally, qualified charitable distributions. Rex, you want to start?
Sure. So this is something that in the realm of charitable giving is newer, that has been established now it's been a number of years, but it's essentially where we can take an asset from a qualified account, so tax qualified account like an IRA account, and we can give it straight to a charity. And thereby we don't have to count it as income as it comes out of the retirement account, because it's being donated straight to charity. The charity accepts it, and again, it's the charity's a nonprofit and a non-taxable entity in this situation, and so they accept it and they can use it. And so this is one way. You have to be over 70 and a half. There are some restrictions on that, but it's one way for people to take their mandatory distributions from their retirement accounts and give to charity and avoid the taxes on that. And so we see a lot of people taking advantage of that tax benefit, because if you're going to give $5,000 to a church or $10,000 to a charity, to a local charity, there's not a minimum on this, and it's extremely simple for most financial institutions to coordinate for you. Another caveat is most of the time, most 401k plans do not allow this strategy to be employed. And so typically the funds need to be in an IRA in order to accommodate these qualified charitable distributions.
Are there, yeah, Brandon, go ahead.
I would just say if you have an IRA, you're older than 70 and a half, and you're giving charitably to some qualified charity, then there's a high probability that a qualified charitable distribution is going to help you tax wise, right? Essentially, what people usually are doing is they're pulling money out of their IRA, they recognize that as income, and then they turn around and donate it to the charity, but they don't get the deduction because they don't, they're just taking the standard deduction. And so they don't get any benefit from that, but they still recognized the whole distribution as income. This way, we just bypass that. You still take your full standard deduction, but rather than recognizing the income from the IRA, from the IRA distribution, we're just sending it straight to the charity. And so you get a full deduction, essentially, is what that's doing, while still taking the standard deduction. And so this isn't a strategy for someone who's making millions of dollars or who has millions of dollars. This is something that is usually very easily done. And really the three qualifications: do you gift to a qualified charity like a church or some other charity? Are you over age 70 and a half? And do you have IRA money? If the answer is yes to those three, I hope it'd be really good to consider that.
Okay. Rex, I think we have one more donor advised funds, but I do want to know who polices, or does it matter if you're giving money to a charity and you want to give a lot of money? Is there a max amount that you can give to charities, and or say you want to give to a charity because your niece or nephew is the executive director, and so you want them to that charity to be set up, but maybe there's a little bit of conflict of interest, or does it matter when you're giving to charities?
It matters. There's not a limit per se on what you can give to a charity. Now, there might be a limit as to how it impacts your taxes, but there's not a limit. Just like with Warren Buffett giving away the $5 billion this year, and again giving over $100 billion, when he passes, that's a pretty high limit. That's a pretty high bar. There's not a lot of us that
Yeah,
can
yeah,
reach that bar.
it's up there.
So there's not a limit.
But you do want to work with your accountant, right? Because where there's not a limit, there are limitations on the percentage of your adjusted gross income that you can take a deduction for. And that varies based on what type of charity you're giving to, whether you're giving cash versus other. But usually, those limits are kind of around that 30 to 50% of your AGI. So a fairly significant amount of your adjusted gross income you can take a deduction for. If not, there's carryover. There's a lot there, but if you're going to give a large sum, we want to make sure you're working with an accountant. Sorry, Rex, interrupted you there.
That was great.
No, I agree with Brandon that there's not a limit, but there are limits to the tax benefits that you need to be aware of and work with your tax accountants on. The other part of your question was, remind me, Brandon, it was
if there's
conflict of interest.
Conflict of interest. Yeah.
Right. So you're not allowed to do self-dealing, right? And so you're not allowed to essentially give to a charity and then designate. So the most common example of that is to universities, to where somebody wants to set up a scholarship at a university and they want to put the restrictions so tight that only their kids would qualify for the scholarship.
Oh, geez.
Right. And that would be self-dealing, and that's not allowed. You're not allowed to set it up to the extent to your family being able to benefit from that gift directly on a tax-free basis. So there absolutely are conflict of interest. There's not a conflict of interest in the sense that if I have a family member that's an executive director of the charitable foundation, of me giving to that foundation, as long as it's not being abused as far as the salary. So just like I'm going to use Buffett as an example again, he's giving to his charitable trust where his 3 kids are going to manage that, and they are allowed to take a reasonable salary, something that is industry accepted, something that is reasonable in nature. They're allowed to do that. Now, if it's above and beyond that, then they can be penalized. And
Well,
it can be
is there
penalized up to
a governing
25%.
body that penalizes, or is that just like the IRS? Like, how does that work?
So it's overseen by the IRS.
Okay.
Yeah.
Yeah.
So
Very good.
that's who oversees these issues. That's who would audit the nonprofit organization or the charitable gift of the individual giving, the grantor, is who would oversee those issues.
Okay. All right. So then we'll wrap up here with donor advised funds, Brandon.
Yeah, thank you. Yeah, so donor advised funds are kind of the intermediary between like a full blown family foundation and then just giving to a charity. You can set up a donor advised fund where essentially you give money, you donate money to this fund. You're able to take that tax deduction up front, and then you can direct which charities that is going to go to. Now, it's not a family foundation in the sense that you're very, family foundations have more flexibility with how and where they donate. Whereas a donor advised fund, you're just picking, all right, I want to give this money to a qualified 501c3 and direct it that way. And so donor advised funds are not as hard to, right? They're easier to set up. They're not as expensive to set up. Really, the reason people like donor advised funds is if they're in a high income year, they want to take an extra tax deduction, and they're going to give to charity anyway. We're going to, instead of spreading it out over 5 years, we're going to gift a huge amount up front that then I can kind of control where it goes over the next 5 or so years, but get the tax deduction up front.
Okay. Sounds good. Rex, anything else you want to add here on charitable giving?
I think I can't underscore, just like I did earlier in the podcast, the complexity of charitable giving and the importance that you work with a financial advisor that has a lot of knowledge in charitable giving, and coordinate those efforts with your accountant and coordinate the efforts with an attorney to make sure there are a lot of so-called gotchas by the IRS in things that you need to make sure that you're doing, whether it be setting up the organization, minutes, who's involved, how much you're giving, the calculations on how much you're pulling out on income streams. It can get very complex very quickly. And so this is one of those situations where I think you really want to leverage the professionals around you in order to execute it efficiently.
And that's just smart. Always leverage the professionals around you. Good advice in the end there. Rex, Brandon from planwithbaxter.com. You can find them at planwithbaxter.com. Thank you so much for joining us again on this podcast. I appreciate it. This podcast was produced by the Banyan Collective and recorded in our trailer here, Banyan 1, inside the Monarch Building. If you found value in this podcast, you can set up a charitable contribution to me, maybe. Even though I'm not a nonprofit, you just got to give me your money. But you can support us at buymeacoffee.com/Banyan Media. That's buymeacoffee.com/Banyan Media. You can do like $5 a month, $10 a month, things like that. And that really helps us out. So we appreciate that. You can watch and subscribe to us on YouTube at Through the Pines. You can like our Facebook page that is on Facebook at Pines Podcast and on Instagram at Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.